Hi everyone, welcome back to my channel. So today's video is all about how to consistently win trades by avoiding common mistakes and also taking into account specific strategies to improve. So we'll just go ahead and dive right into it. So first things first, y'all see I have Apple pulled up here on the option chain, and I'm going to discuss a couple features that you may or may not be familiar with. Now these elements that I'm going to discuss aren't necessarily like secrets, but it sometimes can be information that's overlooked. So I do want to start here at the very top. We see that Apple is currently trading for $247.04. And of course, we see this top line here is going to show you the bid and the ask price. The ETB means that it's easy to borrow. We see that, of course, Apple trades off the NASDAQ. But this is what I want to spend a little bit of time talking about to start the video. So this right here is going to be the MMM, and that stands for the market maker mover. And it's basically a calculation that estimates the expected price movement of a stock. And the reason why traders use the MMM, or some call it the triple M, this is basically used to determine if the option's premium is either overpriced or underpriced. And then traders can also use it to anticipate any potential like gap ups or down within the market. And you can see currently Apple has their MMM set for a plus or minus 3.479, and just rounding it up is a 3.48. So basically what this means is that they project the actual stock price to either rise by $3.48 or they expect the stock price to fall by $3.48. So it's a good way to determine a range for what the stock is projected to do. And you can see that the numbers do change because it's now currently at a plus or minus 3.482. And this is determined by implied volatility. And within this, it is possible that Apple could move up maybe $2.50 or maybe move down by $2.50. It's more so just a projection saying that the max that it could actually reach is 3.48. So their estimation is basically saying that they think the stock price will max out at $3.48 to the upside or the downside. So it can be within the range. It doesn't have to be exactly that. And also, this is not set in stone as well. So it is a possibility that it could be higher or lower, and you will see that the MMM will change. But if you use it to your advantage strategically, it can help you improve essentially what you're choosing for your strike prices. And I'm going to talk about that in just a second. And just to also help you understand a way to kind of like strategize by using these numbers here, it can be used leading up to an event, typically like earnings reports or other high impact news. And it helps traders to strategize around those types of events. And it typically is in three different ways. So the first thing you'll commonly see is that if you hold a position into earnings, you can check this MMM here to determine the potential price movement. So let's just use this example here on Apple. And again, it's trading for $247.04. And it has this MMM of 3.48 at this time. So that's an expected 1.4% move. But let's say the implied move is actually at 5%. You might then want to reconsider holding based on your risk tolerance. So I hope that makes sense. Now the MMM can also validate trade levels, profit targets, or even stop loss placements. Because if the expected move is large, traders might consider volatility-based strategies. And what I mean by that is traders may structure their strategy for directional trades. So you may want to compare an at-the-money strike price at like this 247 to the MMM, and this can signal if a trade has higher or lower probability of success. Now, of course, I'm a fan of in-the-money contracts, but again, there's always strategies that you can utilize in order to improve your profitability. Now, while the MMM offers a good amount of detail into the expected volatility, it doesn't project the direction. So you use it as one of the many data points in your trading strategy. Now, you'll also see that it needs to be something that you set for a realistic amount for your goal. So again, they're only projecting it to move by $3.48. But let's say we wanted to take a look at Tesla, for example. If I pull Tesla up, we can see that the MMM on Tesla is $13.67 at this time. Or if I round it out, $13.68. So all in all, what I'm saying is that you don't want to set unrealistic expectations for what you think the stock will do. Apple is trading within a range of like under $4, but Tesla is trading in a range of $13 to $14. So if you already have this projected understanding, then it allows you to make better placement of your trades. And again, you can also have that entry and exit point already established. That way you don't, one, over leverage, and two, you can position yourself into the trade with efficiency. So all in all, this can help you set practical goals for your price targets. For example, you don't want to say to yourself, Apple can get in the range of $10 or $15 to the upside or downside when they're telling you it won't even likely get to $4, right? Now we know, of course, Tesla can because the volatility is much higher. So you're able to base your decision making on that information that you have. And just keep in mind that it is for a short-term projection with the MMM. So it's not going to be something that's long-lived, which is why the numbers change pretty constantly. So again, y'all, I hope this is making sense so far. Okay, so the next thing I do want to discuss is actually selecting the right strike price. Essentially, this entails selecting the premium that you will pay for your options contract. So as y'all know, for me, I like to trade in the money contract simply because of the intrinsic value. And again, if you're wondering what that means, essentially all it means is that you're going to trade below for calls for your strike price. That's going to trade in the money. But it is important to keep in mind that at the money contracts and out the money contracts are going to be more affordable as far as the upfront cost. So let's say, for example, we're looking at an at the money strike price here at $247. We see that the cost of the premium for the ask is $258, whereas that in the money cost is going to be $410 for this $245 strike here. Now the question then becomes, why is this important? Well, one, you can decide for yourself if you want to base a strategy on your upfront cost and then also determining what that would look like for your delta and your theta. And it also allows you to have the opportunity to see what you can do as far as like maybe doubling up to make an informed decision on whether or not you're comfortable on what you stand to gain versus what you stand to lose. So let's look at it here. Again, this delta is going to be a 0.60 for the 245 strike. We see the theta is also at a 0.59. So this is important to know, that you would make $60 on the contract if Apple was to move up to $248. But if you hold this contract, it will lose the value of $59. Now, in the literal sense, this wouldn't be the best contract to choose simply because the delta is nearly equal to the theta. And you guys can see it actually just jumped. But you can see that they're nearly equivalent. This is honestly not an uncommon mistake for new traders. At times, I've heard that people will enter into trades and they're like, okay, the trade went in my favor. However, I didn't make any money from the trade. Why is that? How could that be? And sometimes it could be the selection of your strike price. You may have chose an option premium where the delta and the theta are actually equal. And if you hold the contract overnight, you guys can kind of see where that presents an issue, right? So that's essentially why it's so important to make sure you're choosing the right contracts. That way the numbers actually play in your favor as well. Not only the trade playing in your favor is important, but you want to make sure that the numbers are advantageous to your outcome goals as well. So this is something to majorly consider when you're choosing your option contracts. Now let's go ahead and take a look at the at the money contract. We can see the delta value is at a 0.47, so $47, but the theta is at a negative 0.57. So this means you would stand to lose $57 if you were to hold this contract. And again, these are not fixed numbers. In an ideal world, they would be, but they're not fixed numbers, and you guys can clearly see that they will move up and down. So the whole point that I'm making here is that you don't want to put yourself in a negative position before you even give yourself the opportunity to enter into the play. That's why intrinsic value is so necessary, and that's why considering the DTE is important as well. So now let's go ahead and take a look at the charts, because I do want to mention a couple things here in reference to understanding how you can read certain patterns and also reading the candles to see how price action is going to dictate whether or not you can be profitable within a trade and if the setup makes sense for what your strategy is calling for. So with that being said, let's go ahead and take a look at Apple for today. I'm going to zoom it in. Now I'm starting here on the 2-minute time frame, and I'm going to just break down a few elements of price action and how you can read the charts. So to start, let's take a look at the very beginning of the market open. We saw that today, the first candle that entered into the market, at least on the 2-minute, was going to be this bullish candle here with an extremely long upper wick. You guys can see this wick here is super, super long and strong. Actually, let me zoom it in just a little bit more so y'all can see what I'm talking about. Okay, so you guys can see this upper wick here, the shadow on the candle is very long. Actually, let me zoom it out just a little bit. That way it's not super condensed. Okay, so you can see that the candle here, again, this is going to be a bullish candle. Now, for some people, they'll read this and say that buyers are in control. For me, on the other hand, knowing the anatomy of a candle, this to me does not signify buying pressure, even though it is a green candle and it is bullish. And let me explain why. Now, the first thing to know when looking at the anatomy of a candle is that the bottom of the body here is where this bullish candle opened. So this was the opening price right here at this 247. Now this bottom wick here is going to be the lowest price within the 2-minute time frame of what the stock reached, and that was going to be this 247, it looks like 86. And then the opposite is also true. When we look at the top wick, this is the highest price within the 2 minutes of time, so the stock rose up to 249.53 at the high. And then here at the very top of the body, this is where the candle closed, and this is going to be at this mark of 248.59. Now, again, the average trader will look at this candle and say, okay, this is going to be bullish momentum. We see that the buyers are in control. However, remember I always mentioned that the shadows, the wicks will tell you the full story, the full picture of what's going on. So anytime you see a specific candle that has a really strong upper wick, this is an indication that the stock price was actually pushed down within the session of the time frame. Now, why does this matter? This matters because you also want to look at the body of the candle as well. Now, granted, it is bullish. However, this selling pressure lets me know that the stock price was pushed down by sellers. So I hope that makes sense on what I'm saying. And just to put it in layman's terms, because the body of the candle is not extended to the same height as the upper wick, it lets me know the true pressure on what side it's actually riding on where the power is truly lying. So although buyers were in stronger control, it doesn't necessarily mean that that's the market sentiment. So for the following candles to be bearish, it makes perfect sense in my mind. And then we saw the fourth candle here, this bullish candle, again, very small body candle, but the upper wick is also very long. So although the buyers took over momentarily, it doesn't necessarily mean that they had total and full control. So again, y'all, this is just my way of breaking down how the market moves and how you read price action. That way you can avoid taking major L's on trades. So if you do nothing else, make sure that you study the candles and understand how they move. Because again, it'll tell you exactly what you need to know without having to use any indicators. If you can just read the charts bare, then you don't necessarily have to guess or even try to estimate essentially what's going to happen next. The patterns and what's going on with price action, it'll dictate everything for you. So let me go ahead and zoom it out just a little bit so you guys can see that there was some extreme selling pressure to start on Apple this morning. We did see a brief moment of a bit of a tug of war between buyers and sellers, but ultimately the selling pressure was obviously more powerful, and we saw that the stock fell all the way down to the low. It looks like at about 2:44, and that's about 9:28 a.m. this morning. And that's when Apple reached its ultimate low for the day. Now, the reason I'm bringing this up is because this is another element to help you understand how to enter into a trade that you may not have been able to recognize prior. Now, when the stock reached this ultimate low for the day, we saw that it was not sustainable in the sense that it tapped into this demand zone here. And when demand is at this level, we know that again, the next move is typically going to be a rally to the upside. Why? Because there can only be so much selling pressure in the market at one time before the buyers then step back over and take control. So in this case, what I'm saying is if you weren't able to take this play for puts to start the morning, you could have actually waited it out, been patient, and said, let me look to see if it falls into a demand zone. And when the stock price did actually fall into this ultimate demand zone here, it would have been a good opportunity if the setup made sense and you also saw a pattern, which I can clearly see here on the chart. If it made sense for what you were looking to do, then of course you can go ahead and say, this may be a profitable setup for me and I can hop into this trade. And in this case, it would have been. Now that we have that understanding, of course, I do want to talk about the importance of using any type of confirmation as far as indicators if you feel comfortable to do so. You don't always have to use them if you're, again, reading price action and understanding how the market is moving, supply and demand, and then, of course, tracking support and resistance. But it is helpful to have further levels of confirmation, and that can be confluence with any indicator you choose. Y'all know I love the ADX. It's going to be something that I always talk about simply because it tracks the strength of a trend. Now we can see at this specific time period here that the ADX was actually in the range of like 29 to 30. So not a bad sense of momentum shift. We can see that it then dropped below to it looked about 16 and then the lowest at about 10. And then we saw that the ADX actually rose back up as the stock price continued to push to the upside. Now, this is an important piece to take into account. It doesn't have to be the ADX. You can use the RSI, or if you're more comfortable using like MACD, even the EMAs. It really doesn't matter what you use as long as you test it out and it's working for your own specific strategy. Just have something that way you can have the confidence to enter these trades while also still maintaining your capital. Because again, those multiple layers of confluence are always going to be beneficial to have on your side. All right, I hope y'all sticking with me and that this is making sense. The very last thing I'm going to mention in this video, I'm going to go back to the trade tab really quick. And I just remembered that I wanted to talk about liquidity as well. So this is important simply because you have to make sure that you're trading stocks that move. So liquidity in options trading, all it simply refers to is how easily you can buy or sell an options contract without significantly affecting its price. And it's essentially just influenced by factors like the bid-ask spread. So that's basically the numbers you see as far as the difference between the bid and the ask price. That's known as the bid-ask spread. And a tighter spread means higher liquidity, while a wider spread suggests lower liquidity. So when you see these numbers, as far as like, for example, this strike price of the 247.50, the bid price is going for 255, the ask price is going for 258. So that's a $3 spread difference. Versus if you were looking at this 242.50 strike price, we can see that the bid price is $580, the ask price is $595, which presents a $15 difference in the bid-ask spread. Now, the reason why this is also important is that the number of contracts you trade in a given period can also be indicative of the volume as well. So that's another piece. So you always want to take into account the volume within any option chain you're looking at. It's always important to analyze how the market is moving, because more volume generally means more liquidity. And the tag along to that is also going to be open interest. The total number of outstanding contracts is always going to be what we have for open interest, because these are the ones that are not actual closed positions. So the higher open interest, this usually indicates more liquidity as well. So again, the final tip, just to help everyone as far as avoiding losses, is that you want to make sure you're trading high liquidity, because it makes it easier to enter and exit trades quickly and at fair prices. Because low liquidity can lead to slippage, and that's basically when you have a value that you don't get fulfilled at, and it could be higher based upon what you expected. That's known as slippage. And you have to essentially accept that where it's positioned at the price that's been set, simply because the bid-ask spread may not have been as tight as you wanted it to be. So again, when trading options, it's smart to focus on these elements: tight spreads, high volume, and solid open interest, just so that you don't get stuck into a trade. So all in all, y'all, I hope this video offered some valuable information. If you found it to be helpful, of course, y'all know, feel free to leave me a comment down below. As always, I thank y'all so much for watching, and of course, I'll see y'all in my next one.